China already went through in the late 90s, when I was first moved there, a massive reduction in structural overcapacity and a massive reform of SOE. Under Prime Minister Zhu Rongji, China fired 30 million, between the mid-90s and the late 90s, China fired 30 million state-owned enterprise workers, mostly in the Northeast. 30 million, that's a big number, even for China. That's more industrial workers than there are in the US today. The US has around 20 million manufacturing workers, so China fired 30 million manufacturing workers in the late 90s. That was proper structural reform. Right now, China is on a pace of firing around 1.5 million per year. So the pace of reform is nowhere near what we had in the late 90s. And I think the main reason for that is that Xi Jinping is still in a phase of consolidating his own power. When Zhu Rongji did that, he was in essence the Jiang Zemin Zhu Rongji team was in its second term. The way you can look at Xi Jinping is that he is still in his first term. And this year, we have the 19th Party Congress, which will tell us who the leaders that will follow Xi Jinping and Li Keqiang will be. And as you enter a Party Congress year, one of the things you know happens in China is that stability is tried to be kept at all cost. And so, as you look to the coming year, from now till October, one of the simplest bets you can have is that the Chinese government will do everything it can to not rock the boat over the coming 9 months. So in late December, in December, I went on a tour of the US and seeing all our US clients, and the bearishness on China was amazingly thick. The bearishness on China was deeply, deeply profound. And a lot of our clients were fearing that 2017 would see big collapse in the renminbi, implosion in the Chinese markets, etc. My point is very simple, is number one, the Chinese government still has a lot of policy tools at its disposals, as we saw in 2016, and I'll come to that in a minute. And it will use those tools to maintain social stability in a year of political transition. This year will not be a year with big developments in China. This year is a year where all of China's leaders get together in a room such as this one and basically spend 6 months planting knives into each other's backs and to figure out who's going to rise to the top. And unless you're in that room, don't expect any particular insights on future developments, which explains what we saw last year. If you think of 2016 was obviously a year of a lot of surprises, and other speakers have talked about them, Trump, Brexit, etc. For us in Asia, one of the potential surprises was the extent to which Chinese growth not only held up, but frankly rebounded, triggering a rebound in commodities, triggering a rebound in Chinese real estate prices. And a lot of that, as these charts indicate, was very much driven by a strong rebound in government spending. If you look at the right-hand chart. Again, this goes back to the theme of stability at all cost. Or here's another way to look at the same thing. If you look at the slowdown in Chinese growth, this is GDP growth broken down by black is GDP growth, blue line is service industry growth, red line is industry and construction. What you really had in 2015 was a big slowdown in China, driven first and foremost by a slowdown in construction. And in 2016, again, one of the surprises of the year was the rebound in Chinese construction. Meanwhile, as you can tell, Chinese service industry growth remained very steady as she went, which meant that not only property sales hit a new all-time high, but property value hit a new all-time high, and floor area sold hit an all-time high. Now, with that picture, again, I come back to you. You got real estate making all-time highs. You got service industry growth being extremely stable. You got construction picking up. Is this to you the picture of an economy that is about to implode? And yet, this is all you read in the papers. All you read in the papers is an economy that is about to implode. A quick chart on Chinese property, because property is such a core driver of growth, and the ability of the Chinese government to stimulate and slow down Chinese property has historically been one of the key drivers of the changes in growth, as illustrated on that previous chart. How much longer can property remain a driver of growth? This is a simple chart looking at GDP per capita GDP compared to per capita living space. And if you look at China in 2008, China per capita living space was around 25 square meter per person. Today, we've evolved as China's housing stock has improved over the past decade. We're marginally above 30 square meters per person. In Europe, we're typically somewhere between 40 and 50 square meters. Now, this doesn't mean that China will be heading towards 40 and 50 square meters per person. But as incomes continue to grow, we have to acknowledge that the first demand of most people is to live in nicer places. Now, when you look at China, you still have about 200 million people that live in completely inadequate housing. Around 200 million people. So you still have underlying demand for improvements in housing stock, and China is still very far from reaching even the levels of, say, Portugal or Spain in terms of living space. Now, one of the big challenges, of course, is given this constant underlying demand, housing in China is expensive, extremely expensive, in absolute terms and relative to incomes. And this reflects the fact, frankly, of a simple lack of space. When you look at the map of China, China has basically the same area as the United States, except, of course, it has more than 4 times the population, and pretty much imagine a United States with 4 times the population and everyone living on the East Coast. Because the center of China is deserts, Tibetan Plateau, all a bunch of areas that are fairly inhospitable to live in. And as a result, what you've seen in China is a big increase in debt and mortgages. And I've got a bunch of charts in the presentation, and I'm sure if you want this presentation, Skagen, I'm sure can send it to you. So the second big story of China, along with growth, has been a story of increasing debt. And this is especially so since the 2008 crisis. In 2008, China roughly had total debt to GDP, if you include everything, local governments, businesses, individuals, central government, had a total debt of roughly 150% of GDP. Today, you add it all, you're roughly at 250% debt to GDP. And that right here is the source of most people's concerns. But let's put it in perspective. You add up all the debt in the US, you're at 370% of GDP. You add up all the debt in France, where I'm from, you're roughly at 350% debt to GDP. Now in France, if we grow by 1%, we'll pop the champagne. We'll be really proud of ourselves. In China, let's be bearish. Let's say China grows by 4%. Let's say 3%. China still potentially has the ability to grow out of its debt. In the Western world, in my view, very few countries do. So the question remains, does this debt increase mean that China face a crisis? Well, frankly, when you look at China relative to most other countries out there, and this is China's household debt, which indeed has increased a lot, mostly to finance real estate, you might get worried because it is on a fast acceleration pace, but you're still below pretty much any major country out there. Even you're below debt in countries such as Thailand and Korea and other emerging markets. And this brings me to a simple point. For all the talk about how China potentially faces a financial crisis, if we look at the past 50 years and the history of financial crises, and before me was one of the greatest historians of financial crises, so I'm a little humbled to be speaking about this, but in my mind, there's 2 ways countries basically go bust. The first, you have a country that runs large current account deficits for years, and in essence becomes dependent on the willingness and kindness of strangers to fund their debt. And one day foreigners wake up and say, you know what? I don't want to buy any more Argentina bonds. I don't want to buy any more Greek bonds. I don't want to buy any more Spanish bonds. I already have too many. And that day, the country needs to have a big devaluation and a big debt restructuring, or the country implodes. The economy implodes. Now, this kind of crisis that you see on the left is not going to happen in China. The reality is that the increase in Chinese debt has absolutely not been funded by foreigners. Let me ask you this. How many of you in this room own Chinese debt? Foreigners have not funded Chinese growth. The increase in Chinese debt has been wholly funded by Chinese savings, not by foreign savings. So this kind of crisis isn't going to happen. The second kind of crisis that you often see is you get a real estate bull market, and banks love lending to real estate because it's easy for them. There's an asset, they know how to do it. And so banks start lending aggressively to real estate. And then one day, banks outgrow their capacity to lend given their own deposits. And so they start borrowing money on money markets, start borrowing money on bond markets. They borrow short to lend long. And here lies perdition. Each time banks borrow short to lend long, you have to start getting worried. And the question is, could this be happening in China? Could this be what we are now facing? And I'll skip a few charts in the interest of time. But the reality is it most likely will happen one day, but we're still very, very far from it. Because when you look at Chinese banks, the way you have to conceptualize Chinese banks is that these are poorly managed banks that make bad loans. And NPLs tend to be fairly high. But at the same time, they're extremely conservatively run institutions. If you look at total credit in China is equal to 1 times bank deposit, which means that Chinese banks do not fund themselves on money markets, they do not fund themselves on bond markets. Chinese banks fund themselves on the fact that China in the past 20 years has gone from 200 million bank depositors to 800 million bank depositors. This is the big transformation. The increase in debt in China has been made possible by the fact that all of a sudden, in the past 10, 15 years, the savings have come out of the mattress and gone into the banking system. And for a bank, there is no more stable way to fund itself than through the deposits of the broader public. My father always says that people are more likely to change wives than to change banks. And this is true. This is true. The bank deposits are immensely safe, which is why when you talk to the big China bears, inherently the bearish scenario in China is always very simple. And it has to come down to this. It's that the general public will take their money out of the banks and put their money abroad. That's the only way you can get to a bearish scenario in China. Which brings you to the big question of the day and the question of capital outflows in China. And this chart right here, the Chinese central bank reserves, which have gone from $4 trillion down to $3 trillion in the past couple of years. And here, I come back to my first question to you. Do you trust Chinese data? Because this piece of data, you get from the Chinese central bank. So if you're not going to trust Chinese GDP, and you're not going to trust Chinese industrial production, and you're not going to trust Chinese retail sales or bank deposits or whatever else, why are you going to trust this one? The reason I ask this is fairly simple. Is this time last year, we were told $1 trillion left China in the past 6, 12 months. And I looked at that and I thought, gee, how did it leave and where did it go? Because $1 trillion is a whole lot of money. At the same time, I know this. I know that last year, China ran a $600 billion trade surplus, which means that for reserves to shrink by $1 trillion, basically you would have needed $1.5 trillion of capital outflows. And again, that's a whole lot of money to move around. How did it leave and where did it go? Now, a lot of it went to repay US dollar debt. Chinese corporates in the past year have repaid probably around $300 billion of US dollar debt. And you see that in the books of HSBC, in the books of Standard Chartered, in the books of all the big banks that do business in China. But that, in essence, is a fairly positive development. There is a lot less US dollar debt in China today than there is elsewhere. But you're still left with the question of, how did so much money make it out? There's a few ways for people to take money out in China. One of them is through the Hong Kong-Shanghai Connect. You can open a brokerage account in Shanghai and buy Hong Kong shares by pushing money out of China. But the volumes on the Hong Kong-Shanghai Connect have been dismal. And now they've opened the Shenzhen Connect, and what you find is on any given day, only a quarter to a third of the daily allocation is being used. So for all the talk about how people are lining up to take their money out, the legal ways that people have to do it, you don't really see that big increase in cash coming out. If you look at Macau, which has historically been one of the key ways for the Chinese general public to get money out of China, gambling revenues have collapsed by 2/3.